Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Well, are we getting a David Copperfield show here on the markets? Things are not as they appear. Can you explain?
Well, in my opinion, things certainly are not as they appear. Everybody is kind of lulled to sleep amidst the grand illusion, I called it. I did an article way back in 2000, and I say way back, is about a year ago in Stocks Commodities Magazine, and talked about the grand illusion. But, I printed out some charts and thought about some things I wanted to cover in the interview today to try to make a point. And, I've talked about before how, if you're looking at equities, pretty much all equity averages ebb and flow cyclically to a very similar rhythm. Sometimes the extent of the rallies or the declines vary, but, between the averages, be it that you're looking at, let's say, the NYSE versus the S&P or versus, the DAX. The extent of the move may vary, but the cyclical rhythm is there and is very, very similar. And on that note, I want to make mention that, did you know that the FTSE it has traded back to below the 2017 low. Kind of a stealthy move that no one is looking at. And you say, well, what's the significance of that? Well, let me walk you through something. And this is not the sole basis of any kind of analysis. It's a high level comparison to just try to make a point, because there's obviously much more to it than just the comparison, but the structural rhythm and the way with everything is really just the high level point I want to make. But people probably don't realize, for example, the FTSE crashed in 1987 just like the industrials did. They made a 4-year cycle top in 98, a 4-year cycle low in 98. They peaked just ahead of the industrials they peaked in December of 99, whereas the industrials peaked in January of 2000, and I think it was March of 2000 on the S&P. They bottomed following the cyclical rhythm. The FTSE, it bottomed in March of 03 versus October of 02 on the industrials, and kind of did like a double bottom in March of 03. And then, we had a high just like everything else in late 07. In the case of the FTSE, it topped in July versus October on the industrials. Had the same bottom in March of 09. Very similar top a month apart in 15. And in this case, the recent 4-year cycle low was made in February of 16, with a most recent high in 18, January of 18. And now we've moved below the previous, year's low. Well, if you look at those 4-year cycle, the rhythm of those 4-year cycles, what you see is that when the previous year's low is violated, that's typically something you see on the downside piece of a 4-year cycle. In other words, after you've rounded the curve of the 4-year cycle advance. And so on the surface, I know that's just, it's kind of a high level analysis, like I said, but there's no other evidence on some of the other indexes that we've seen that, but it looks like the FTSE is leading here in that violation alone is indicative of a 4-year cycle top. And so, it's just like I said, it's just kind of a stealthy little thing that no one's really talking about. On that note of things not appearing as they seem, looking at the American Stock Exchange, no need to go through all the tops and bottoms. You get the point. But you have the same overall cyclical 4-year cycle rhythm, as with everything else. And I don't think that very many people probably realize is that the advance out of this 4-year cycle low, the January 16 4-year cycle low, has not carried the Amex back above the, in that case, it peaked in July of 14. It peaked a little bit ahead of everything else. But it has not bettered that previous 4-year cycle top. So you have like this, divergence or non-confirmation, if you will. Well, why? I think that's a warning. And, moving on to another couple of averages, we've talked about the Tel Aviv before and how the structure there has bothered me. Well, we have the same thing there. The advance out of this 4-year cycle, most recent 4-year cycle low has not carried the Tel Aviv back above its previous 4-year cycle top. And then, the question is, well, why? You're seeing these divergences. Those are warnings. And if the Tel Aviv has always moved above the previous 4-year cycle top with the industrials and all the other mainstream averages, and now it's not, why? What is that telegraphing? It's a warning. Same thing with the Amex. If the Amex is always confirmed, if you will, the movement of the other indexes, and now it's not, I have to take that as a warning. That's actually part of the basis of Dow theory is that the industrials and the transports confirm one another, and so this is somewhat a derivative of that. It's not Dow theory, but I'm saying it's the same concept that these averages are not confirming. And then, last but least, there's one more. No one looks at the Russian market, but I do. I look at a lot of stuff, and the same thing here. You have a very similar cyclical rhythm, but the Russian market has not moved above its previous 4-year cycle high either, whereas in the other cases it did. And so these are cracks. This is not the basis of my analysis by no means, but it's just a high-level observation to try to show that there's something going on here. Something is not right, and as you said, things are not quite as they appear, and I think that these non-confirmations and these broader averages are telling us that.
We'll have more with Tim Wood right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're chatting with Tim Cyclesman Wood. Tim, what do you see happening on the North American markets if they start to mirror what's happening in Moscow, London, and Tel Aviv?
Well, I think it's a process. We're waiting now for some solid structural evidence. We need to see a good, clean Dow theory primary bearish trend change, and I need to see some cyclical structure that tells me that it's broken. As we await that setup, or that confirmation, I should say, the setup that we have here is very fragile, far more than people may realize. And, I've used this analogy. It may be kind of corny, but, a technical setup is much like driving down a road and going to an intersection. When you get to the intersection, you have the opportunity to turn. Doesn't mean you're going to, but the opportunity is there. And, if you're not at the intersection, then you don't have the opportunity. Well, we're at that opportunity. And, this decline that we saw back in February, it left the market in a somewhat vulnerable position. When I say the market, the industrial specifically, we didn't see some of the structural violations on some of the other averages, but we did on the industrials. And so they're in kind of a precarious spot. Does it mend? Does it take another 6 months? Does it, or does it break down? The opportunity is there to wake up one morning and the thing just start to fall apart. And that's what makes it so darn dangerous. I talked about this, actually in my recent letter it was released last weekend, and, talked about how the Russian market and some of these other foreign markets were, I don't remember my words, but on thin ice because of the structure there. And then the next day, on Monday morning, the Russian market was down 8%. Just boom, next day. And so that's the risk that we face here because of this structure. And if this structure bites at this intersection, then it can start to come unraveled pretty soon. And so how quickly this takes hold or bites, that's crystal ball. I can tell you that the opportunity is there. And what makes this, I think, so, dangerous, a number of things, is number one, no one sees it. Number two, it is occurring, as we've talked about, at what I think is the top or near the top of a massive bubble that, again, no one sees. We talked about that for years. And, if you're immersed in an environment long enough, then all of a sudden it appears normal. And so, consequently, no one understands or sees the bubble.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, with the markets here at what could be their peak, what's going to happen with gold?
Look, let me walk you through some numbers. I actually put some stuff together to illustrate this point as well for this interview because it's important. There's been some concern and some confusion about the 9-year cycle low in gold because the 15 low occurred way too early to have been a normal 9-year cycle. And, sometimes structure, when you get enough evidence, structure will dictate, that, okay, you have to accept that abnormality and it is what it is. And we're almost there. I'm starting to really lean toward that 15 low having been the 9-year cycle low. The jury's still out on it. I still need to see a little more evidence with this next intermediate term decline. But that said, let's put gold in perspective and what the problem is here, and I'll knit this whole picture together for you in a minute. But I just picked some of the moves out of some 9-year cycle lows in gold and compared it to the XAU. And, back in coming out of the advance and looking at the chart, I can hardly say, I think it was 84 into 87. Gold was up 66%. And during the corresponding move, the XAU was up 170%. Looking at another move coming out of the 83 low, gold moved from 325 to 411. That's a 26% move. The XAU was up 128% for the same corresponding move. moving forward to 01, gold bottomed in 01 at 256 and moved to, if I can read my writing here, well, I didn't write the number down. Yes, I did. Moved to the high in 08 of 1,033. That's 303% move for gold. The corresponding move in the XAU was 403%. It outperformed gold. That's the point here. Every one of these moves, it's outperformed. The last move into gold at the in 2011, coming out of the 2008 4-year cycle low, gold went from $736 an ounce to $1,923. It's 161%. The XAU was up 266%. Again, it outperformed. Well, here we sit, and some want to argue that like I said, that the 15 low was the 9-year cycle low, and maybe it was. And I've said, careful what you wish for, because it may not be a good thing. And I've realized and acknowledged that it could be the 9-year cycle low, and still do, and still waiting for that confirmation. But here's the facts. Gold has recently moved back, made a little push this last week, and has moved back above its recent January high. And in doing so, it's sitting basically at the high from, coming out of the 9-year cycle low in July of 16, I believe it was. And, so we've gone nowhere. But at the same time, gold is flat, if you will. I mean, it's at the high point for the move out of the 2015 low is the point, if you can get that in your mind. But the XAU, to the contrary, if you look at it, it's nowhere near the high point for the move coming out of that 2015 low. In fact, if you look at a long-term chart of the XAU, it's at 1984 levels, to put it into comparison, into perspective. Something is wrong. It's not as it appears. As you said, there is, none of this is as it appears. It's like the article I wrote in Stocks Commodities Magazine in, I think it was March of last year, The Grand Illusion. This has all been a liquidity-driven, bubble. And these non-confirmations, like I talked about, between the averages, the equity averages, the behavior here between gold and the XAU. Yes, commodities have held up better than expected, but they haven't gone anywhere. Yes, the bubble has taken forever to form and move into this top, and it's blown up into a far bigger bubble than imagined. But it doesn't change the fact that it's a bubble, and these cracks are there. I mean, I'm not making this stuff up. I mean, the math is what the math is, and the history on the chart is what the history on the chart is. And these are warnings. But people have been so lulled to sleep because this thing has taken so long to form that, they just don't take heed to the warnings or what it's trying to tell us. And what I think we're setting up for is that if we have seen the 9-year cycle low in gold, and if this top in equities does continue to form as it appears to be trying at this point, I think what we're setting up for is a complete collapse of all asset classes together. And unless this structure starts to change to give us a brighter picture with that, as long as this is taking, that's what I'm seeing. That's the direction that this is looking to me.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.